Hi everyone, welcome to today's video where I will be breaking down the fundamentals of the financial market. If you are new here, I am business analyst, I am working in investment banking and I am also MBA and CPA qualified. Whether you are curious about bonds and stocks or how global currency fluctuate, then you are in the right place. So what are the financial markets? So financial market is the place where people sell and buy financial assets like bonds, stock or currencies, or commodities, which can be example of gold and oil. Think about this like marketplace, but instead of people trading on the goods like clothes and food, they will be trading on the financial products in order to invest and raise or grow their money. So let's break down what the simple purpose of the financial market. So first is the raising capital. Here is when the company they want to expand or grow their business. So as an example, they can issue the stocks as the part of their business or also bonds as the type of the loan. The second purpose is facilitating the trades. So financial market allowed people to sell or buy those financial products very easy and efficiently. It's like grocery store, which makes very easy for you to buy anything you need. And another purpose is risk management. Here is where the companies they can use special tools like option and futures to protect themselves from the big changes in the prices, which help them to manage the risk. It's like buying insurance to guard you from the potential losses. So what are the major types of the financial markets? First, we have a stock market. Stock market is where the companies sell the part of ownership of their businesses by calling stocks. When you buy a share, then you own a small part of the business of that company. So what does it mean? When the company does well, then your investment will grow. But if for some reason the company struggles, then your share can go down. So the price of stock changes based on the supply and demand. So if more people they want to buy stock because of they believe that company shares will go up, then of course the prices will go up. And on the other hand, if people they lost confidence in some of the businesses, then they will start to sell their shares, and of course in the same time what will happen that the price shares of the company will go down. Example, imagine that Apple release a new version of the iPhone which become very popular. So people expect that Apple will make a lot of money from it, so investors will start to invest in the Apple stocks. So as the result, the demand of the Apple shares increase, so the prices also increase. So on the other hand, if the company faces some bad news, maybe lawsuit or some poor earning report, so investors they might be worried about future company profit, so they start selling their share. If many people they start to sell their shares, so this can affect on the prices of the shares going down. So why the companies sell their shares? So as I mentioned briefly already, when the company they are looking for expansion or they need more money for research development area to launch new products, so this is where they sell their shares to raise the capital. And this process called initial public offering or IPO, where the company stocks is offered to the public for the first time. Now let's talk about the bond market. Bonds are the way for governments, companies, organizations to borrow money from investors like you. When you buy a bond, you are essentially lending money to them. And in the return, they promise you to pay you the full amount that you lend them, which called principal, at the future agreed date, along with the interest regular payments along the way. Those interest payments called coupon payment. For example, let's say you buy 5-year bond from the company with the 4% of the interest rate, which is also called coupon rate. So if the bond's value is $1,000, then you will receive $40 each year for the next 5 years, which is 4% of that principal that you invested in the bond from the initially. And at the end of the 5 years, company also will return you $1,000 which you originally invested. Bonds are considered generally more safer compared to the stock, because even if the company doesn't perform well, then legally they are obliged to pay bondholder before stockholders. And of course, because of it's a lower risk, then they will offer you the lower returns compared to the stocks. Here is another example of government bonds. Let's say government want to build new school, new roads, new hospital, but it doesn't have enough money. So here where they can issue the bonds. And you can buy 10 years government bonds with the 3% of the interest paid. And if you invest $1,000, then you will receive $30 each year over the next 10 years. And at the end of the 10 years, government will give you also that $1,000 which you initially invested. Here also another example of government bonds, like treasury bonds. Those are the bonds which usually issued by government for 10 or 30 years of the period. Then another example, we have municipal bonds. Those are the bonds that issued by local authorities or state or city, and for the similar causes like to fund the project for the public school, roads or utilities. An interest rate which is earned from municipal bonds very often can be exempt from the federal taxes, which of course make it very attractive to the investors. Then there is also many other types of the bonds, like corporate bonds, agency bonds, foreign bonds. Let's look now in the commodities market. The commodities market is where raw material and natural resources are bought or sold. Those include things like metal, which can be gold, silver, and natural resources like coffee, corn. Commodities are very important because they affect prices of everyday items. For example, if the oil price go up, then you might be observe the increase also in gasoline prices, which can also make transportation more expensive. This eventually can lead to the higher costs in the goods and clothes because it's become much more expensive to deliver them. Gold is often considered as the safe haven investment. So when the economy is unstable, then investors they tend to buy a lot of gold because it tends to hold the value. As the result, the price of the gold can go up during economic downturns. And here we also have foreign exchange market or forex. This is where different currencies are traded, and this is one of the largest markets in the world. For example, if you ever travel, you exchanges dollar to euro. So this is where actually you participated in the forex market, and the value of currency change based on the economic conditions and interest rates in different countries. So in the financial market, there is always balance between risk and rewards, and higher investment in stocks like in new tech startup can offer you high potential returns, but they are also more likely to lose the value. On the other hand, the lower risk investment like government bonds, they can offer you much more modest returns, but they are much safer. Financial market, they may seem complex at the first, but they are very critical how the global economy functions, and they can be very powerful tools in building the wealth. If you found this video interested, please also check this one, and don't forget to subscribe if you haven't yet. And thank you very much for watching me, and see you in the next video.